Please welcome back to the stage, Bloomberg's Haslinda Amin.
Thank you. Hello there, and welcome back to the last sessions of the day. We've heard from the finance ministers earlier, and now we'll speak to the central bankers on monetary policies and how to tame inflation, combat a strong dollar, and of course, how AI could revolutionize banking as we know it. So, let's get started.
Please welcome to the stage His Excellency Sheikh Bandar bin Mohammed bin Saud Al-Thani, Governor of the Qatar Central Bank, and Fatih Karahan, Governor, Central Bank of the Republic of Turkey, for a conversation with Bloomberg's Jumana Bersachi.
Hello again, everybody, and welcome back from lunchtime. So I'm really looking forward to this next panel, and their excellencies and myself were having a chat offline, and I said to them, it's really difficult to be a central banker because it's like shorting an option for those of you who are involved in finance in the room. If you're cutting rates, it's because growth is weak and people are losing their jobs, and if you're hiking interest rates, it's because inflation is high and people's incomes are seeing a hit. So whatever you do, people are going to be criticizing. But if you add your monetary policy and price stability mandate to all of the other things that central banks have to think about today, from climate change to artificial intelligence, it really does make for an interesting mix. So throughout the course of this conversation, we're going to talk about some of the macroeconomic challenges, and then we'll switch to perhaps some of the more medium-term challenges, artificial intelligence being one of them. Your Excellency, I'd like to start with you. 2022, 2023, I feel the discussions with central banks have just been dominated by inflation, the inflationary outlook. What started off as a supply shock became more of a demand shock over time. How do you see the global inflationary outlook from here onwards?
Thank you for having me, Jumana. As you know, in 2023, the inflation has been improved significantly. That due to the improvement in supply chain, as well as the decline in the prices of foods and energy. But from the beginning of 2024 until today, the inflation has been varied from country to another, from geographical area to another. For example, in the United States, the inflation is still high. In the beginning of the year, there was expectation for cutting like three cuts for this year. But now things changed because the numbers, the data that's coming from the economy is changed. So in US, the inflation is still high, and the interest rate might stay higher for longer. While in Europe, for example, we can see that the numbers and the data that comes from Europe showing that the inflation is in their trajectory to decline to 2%, which is a better situation than US. So we might see earlier cut in interest rate in Europe than in US. Any central bank will not move to cut an interest rate unless they are confident enough that the inflation is to its target level. They need more confident data for them to move and cut interest rate.
Yeah, that's certainly the messaging that we're getting from central bankers. Dr. Fatih, let me ask you about Turkey, because the dynamics there are a little bit different. You've got inflation close to 70%, 69%. You just recently upgraded your year-end forecast to 38% from 36%, but that's still very much below where inflation is right now. And people often say that you have to see it to believe it. So what are you doing to manage people's inflation expectations?
Thank you. So the latest reading is 69.8%. And actually in May, because of base effects, it's on track to go up a little further, probably reaching 75% or so. And then we're on the verge of a big decline in inflation in the second half of the year. There's a couple of factors in this. One is there's going to be some favorable base effects, but also the underlying trend of monthly inflation has been coming down because of the tightening that we have done. Now, if you look at market expectations, the markets agree 100% that inflation is going to come down quite a lot. We disagree a little bit on where it's going to end. Our forecast and our target for year-end is 38%. But market expectations, being around 44%, and our policy rate being, 50% in simple terms, 64% in compound terms, is actually quite a tight stance. And if you look at, financial conditions, various indicators of market interest rates are quite high, and credit growth, which is a leading indicator of demand conditions, has come down quite a bit. So we think in the second half of the year is going to be really supportive of this inflation, and will be, on track to hit our targets.
So thank you for spelling out how you envisage the inflation profile. Let me just ask you, if you did get an upside surprise in inflation, higher than what you penciled in, would you hesitate to hike interest rates again? I know you've said you'll do whatever it takes.
Yeah. So, great question. Look, you talked about the popularity of central bankers, or actually unpopularity. We're not in the business of being popular. We're in the business of doing our job, which is to get back, inflation back on track, to reach price stability. We've had upside surprises before. This happened in the month of February, in March, when we had the February reading, which was a lot worse than we anticipated, and we reacted strongly. So we're cognizant of the risks, upside risks, and we're ready to act, to do whatever it takes to bring inflation down by the end of this year, in line with our forecast. But it's not just this year. Our longer-term forecast, target is 5%. So our goal is to bring it down to 38% this year, and then 14, and then to single digits, and then thereafter too. So it's a long process, and we remain committed to keep our policy stance tight.
Well, the last time a central banker said whatever it takes, they were successful. So this is version 2. Let me ask you about, Your Excellency, about the sort of the importing of tight monetary policy that Qatar has from the US. Obviously, you have a pegged currency, and you spoke about the Fed and the position that they're in now, that they are hesitant to start cutting rates before they're sure that inflation is on the right path. How does the tightness of the monetary policy that's set by the Fed affect Qatar and the Qatari economy? And would it be a relief for you if they did actually start cutting interest rates?
Yeah. Thank you for this question. As you know, we are pegged to US dollar. And as a central bank, our main duties is to maintain the peak rate. So that's why we are keeping the interest rate high in the state of Qatar. Despite that, the inflation has been declined to a reasonable level. So our job is to maintain the peak rate. Our job is to make sure that we don't see any capital outflow from our market. So we have to manage between having a balance between monetary policy and also maintain growth, as well as protecting the economy from outflow of the capital. Historically, this regime worked very well for the state of Qatar. We are going to keep our currency pegged to US dollar.
Yeah. I heard that earlier from His Excellency Jadaan as well on our earlier panel. Let me ask you a question about growth. How important is it to the central bank that keeping rates restrictive doesn't tip the economy into the recession?
Thank you. So if you look at Turkish growth, the growth of Turkish economy, last year, for example, growth was strong, but it was entirely driven by domestic demand. Actually, the contribution of net exports was negative. That means there's a large current account deficit, and that means there's a drain on our international reserves. And so by bringing inflation down to price stability, we'll have healthier growth, more sustainable, maybe at a somewhat lower level than last year, but in the longer term, it will help us grow at a less volatile, more sustainable basis. So we don't see in the longer run a trade-off between the two.
So short term, if it does have an impact, the messaging to the public is going to be long term, the path is still on track.
Yes, we have to bring inflation down. If you ask, anybody in Turkish public, what's their number one concern about the economy, is that the prices are too high and they are growing at a high rate. So our contribution to social welfare, our biggest contribution to social welfare, is going to be by making sure that we go back to price stability.
Well, let's talk about some of the medium-term drivers of inflation. Artificial intelligence, obviously a hot topic here. I'm just curious, maybe if we can start before going into the financial stability aspect, just from a macroeconomic perspective, how you see artificial intelligence impacting medium-term productivity, and if overall you see it as inflationary or disinflationary, because I've heard both arguments.
Okay. Regarding the AI and the relation between AI and the inflation, in the mid-term to long-term, my own belief that the AI will contribute to bring inflation down. Why? Because AI assumed to enhance efficiency and productivity, and also to improve profitability. So that also AI might replace some of the jobs. So the midterm to long term supposed to contribute to bring inflation down, but in the short term, I believe that AI could contribute to increase the inflation a little bit, because a lot of institutions now, they need to invest in hardware, software, this new technology, training. So that might cause the prices to increase a little bit.
How do you think about it from the Turkish economy perspective? Turkey obviously has a huge manufacturing hub. How does the advent of artificial intelligence and its potential implementation have ramifications on the Turkish economy? How are you thinking about the real economy impact?
Thank you. So first, obviously, it depends on adoption. And for adoption, you need a workforce that's agile, that's adept at change. It can be retrained and can use new technologies. That's going to be really key in making sure that we can adapt to this new technology and we can make the best out of it. Now, in terms of the precise impact on productivity, you can make two different cases, honestly. It's clear that the potential is really huge. I mean, we see it, in the news every day. With every new advancement, there's something, fascinating that comes out of it. What exactly the productivity impact is going to be is a little bit uncertain. It could be the thing that's going to keep us growing at the pace that we've grown in the past. But it could be the thing that's going to make the world grow faster. But it's really too early to say, because there's a lot of work ongoing that's trying to figure out what's the best use of this technology in productive uses. So there's a lot of uncertainty.
Yeah, it's still early days. From a financial stability standpoint, I know the central bank also has oversight over the financial system as well. Do you think that the adoption of AI from the financial system could pose any financial stability risks?
Very great question. First of all, we have to understand that AI is not a new topic for financial industry. Financial industry is a data-driven industry, and financial institutions, they used to have predictive models, algorithm technology, for example, trading. But however, with the new AI technology, we assume that this technology, by adopting this technology in the financial institutions, is going to enhance the efficiency, improve customer experience. They will be able to manage their risk better, as well as to better manage their compliance. So is there risk or not? There is a risk. And any new technology it comes with a risk. So, but the question is, what type of risk? In my point of view, my concern is about the biased data, data privacy, market manipulation, and reliance on AI for decision making. To some extreme cases, might affect also financial instability. But the main concern is cyber attack for me. So cyber attack and abusing this technology to attack financial institutions, this is my major concerns. So as a regulator, we have to, first of all, we have to improve our institutional capacity, and we have to hire skilled people to closely monitor these new technologies that have been adopted in the financial institutions. Also, regulation is very important. In the state of Qatar, in Qatar Central Bank, we're going to, in a few weeks, we're going to issue our first guidelines how to adopt AI in financial institutions. That's going to help financial institutions to better adapt AI and mitigate the risk.
Is that a legal framework that you're putting together? Are you working on a legal framework around the adaptation of AI?
We are working at this stage. We are working in the guidelines. These guidelines now, we send it to the financial institutions as a consultation paper. So we're going to see their feedback, and then it's like a framework. Also, it's governed the data. It's governed how to apply the AI, the risk modeling, etc.
Well, Dr. Fati, what role do you see for central banks in monitoring and assessing the risks associated with AI? You've got a lot on your plate already. Is this just going to add an extra operational burden to you?
So, I mean, the Turkish Central Bank does not have a supervisory role. It's a different agency. So for us, it's not so much a concern about the systemic risk component, but more, of course, we're monitoring the impact. So there's a couple of use cases for us. One is, for example, just making sure we get the right insights from real-time data. AI is great in parsing through complex data and generating insights. And so in that sense, it can help us figure out what's going on in real time. But more for the long term, obviously, there's a question of what the impact is going to be on the real economy. And there, there's two margins. One is through inequality, because the labor market effects are a bit uncertain, but AI has the potential to be a little bit different than the last round of technological innovation. The last round was automation that displaced pretty much middle-income jobs, routine tasks, for example, and led to job polarization. But AI has the potential to displace, there's a possibility maybe, we're talking about doctors and lawyers and maybe economists. So it's very different in terms of where in the wage distribution it's going to impact. So the inequality implication can be different. So in that sense, in terms of when we're talking about central bankers, we talk about the natural rate of interest. So inequality is a channel that can affect that. And also productivity growth, which we already talked about. If productivity goes up, obviously then the natural rate goes up. So these are things that we closely keep track of to figure out exactly how AI is going to affect the real economy going forward.
Well, you've inspired a question. I'm going to go back to the beginning, which is a question about the Turkish economy. Since you bring up income inequality, a series of measures were put forward by your Turkish finance minister yesterday, Mr. Şimşek, and I wonder to what extent that package is going to address some of the concerns people have about income inequality in Turkey right now.
So the package, the package that was announced yesterday were a set of spending measures. They're not, they don't have first-order effects on the distribution of income. It's really to help us in our fight against inflation. It's to help us tame domestic demand, which I explained is too high and needs to be moderated. So the Minister of Treasury is coming to our help with the spending package.
Yeah, all working together. Final question to you, Your Excellency. What would you say is the biggest risk on your radar as you think of the outlook in the next couple of years? It doesn't have to be AI. It could be anything that's on your radar. What is keeping you up at night?
Honestly, political instability. We need to see political stability in the regions, in different regions, to see more growth in the economies. We are, as an economist and policymakers in the financial sector, we want to see stability in the regions for the economy to grow.
Yeah, yeah. I think everyone here would echo that sentiment. Your Excellencies, thank you so much for this fascinating conversation. We spoke about a lot of topics. I wish we had more time, but thank you very much for your time.
Thank you.
Thank you.
Please welcome to the stage Her Excellency Mariam Al-Suwaidi, CEO of the Securities and Commodities Authority of the United Arab Emirates, Jim Coulter, founding partner and executive chairman of TPG, His Excellency Professor Njuguna Ndung'u, Cabinet Secretary, National Treasury and Economic Planning, Republic of Kenya, and Samaila Zubeiru, President and CEO of the Africa Finance Corporation. For a conversation with Bloomberg's Haslinda Amin.
Well, it is a race to net zero and to keep 1.5 degrees alive. And to get there, we need radical solutions, not to mention $7 trillion annually. But that's just an estimate. The figure changes according to who you speak to. So how do you get all the stakeholders, regulators, investors, companies, to come together to find a more cohesive and strategic response? So Marla, let's start with you, because we know that climate is a huge issue for Africa. It loses something like $7 to $15 billion a year because of climate. How are you looking? What is your approach when it comes to climate?
Thank you very much for that question. I think in 2022, we published a white paper on Africa's pragmatic path to net zero. There we argued that in spite of Africa not being responsible for most of the greenhouse gas emissions, and the fact that we're the most severely impacted by the adverse impacts of climate, we can play a big part in the solutions. And we argued that Africa's best part is not to reduce emissions that we don't have right now, and that there's a window for us to have a different trajectory for growth. Actually, most of the developing countries have an opportunity to take a different growth path so that that is less carbon intensive and has less emissions. So our view is Africa has over 40% of the minerals and resources that are required for the energy transition, because the energy transition is going to be electric. It means that it will be electrified going forward. And Africa has a lot of those minerals and metals. it also has significant renewable energy sources to process those minerals and metals with the least carbon intensity. So if you think of the fact that the world is going to go electric, you need lithium-ion batteries, you need copper, cobalt, you need wires, bauxite, so all of those things are in Africa. And in Africa, you can process them, with renewable energy sources. So the International Energy Association tells us that we have 10,000 gigawatts of solar potential with just 1% built. We have 110 gigawatt potential of wind energy with just about 11 gigawatts built. We have 15 gigawatts of geothermal energy with less than 1 gigawatt built. We have 400 gigawatts of thermal gas potential with less than 5% built. And if we're going to move significantly, to an electric world, it only makes sense that these minerals and metals are processed in Africa. And we're working on several initiatives around that. We have special economic zones and industrial parks that we've built and are transforming African produce and African minerals and metals into semi-finished and finished goods. We are just about to start processing the minerals and metals. We are now focused on adaptation. Again, we argue that Africa's infrastructure is yet to be built. So in building infrastructure going forward, we need to incorporate climate risks in fiscal Africa to build. And we are raising an infrastructure climate resilient fund where we got Green Climate Fund to work with us on a blended finance architecture whereby they're providing the first loss and we are raising second loss from ourselves and our counterparts, pension funds, and sovereign wealth funds as well, to demonstrate that there is capacity within Africa to fund the energy transition, and we are making steps to fund that. We are also focused on how to increase energy access, and we are investing in renewable energy. We're actually one of the largest renewable energy investors on the continent today, and we have recently commissioned a wind farm in Djibouti that is going to move the country to their part. They have chosen a part that they want to be 100% powered by renewable energy, and we are helping them on that part. And there are many initiatives that we're working on, across solar and wind in Egypt, in South Africa, in Kenya, geothermal in Kenya, wind, solar in Senegal. All across the continent, there is potential for us to advance the energy transition. Our focus has been on developing to de-risk, and then inviting partners to work with us.
We'll build on some of the things that you said slightly later. Secretary Dungo, for Kenya, it's also critical, right? I mean, you just had a flooding, which caused the deaths of more than 200 people. How are you doing things differently, looking at climate differently?
Thank you very much indeed, and I'm very happy to be here. But let me also say that the person who was invited to this forum was His Excellency, the President of the Republic of Kenya, so I substituted him. And you could have seen.
We're glad to have you with us.
You could have had more drama with the champion of climate change in Africa, that is President William Ruto. Let me say that as the Cabinet Secretary to the National Treasury, the whole issue is why am I talking about the net zero? It's because just like you have mentioned, we have had a drought in 2022, one of the major droughts, followed by El Nino, and now we have maybe one of the most devastating flood season in Kenya. And that tells you the severity of the problem from my end is diversion of fiscal resources to cater for lives, to save lives. You can imagine that we cannot even talk about what he said. We have 93% of our energy as renewable. And I would agree with him, investing in this renewable is very, very important. But for us, even the transmission is going to be more critical. But can we manage to do that? We cannot manage to do that because you can see we have layers and layers of severe negative climatic shocks. So they have diverted a lot of space, fiscal space into that. But then let me go back to your question. I think the first thing is actually to recognize that we have to shift. We have to make a proper shift in terms of investing in adaptation and resilience. And that's very, very critical. And it has to start from the low end. We have like the tree planting, for example, across. Over the weekend, I was even giving school children fruit trees, because I believe that that is where we have to start in terms of the investment we need to change. The ecological restoration is going to be very, very critical. And that for us is very, very important. And then we go into, for example, we were excited when we started talking about climate change and carbon markets. But there are difficulties even creating that kind of regulations required in terms of entry into that space, and even the whole spectrum of what we really need to do in terms of changing the technological transformation that is required to resolve this is quite massive. And so we are working on different fronts. And can I say, there are so many moving parts. And we have to make sure that we predefine where we start in all these moving parts, so that we have a tractable path of net zero, investment in net zero. There are so many aspects of that, but I can come back to those later. But for now, I think a whole range of, let's say, transformative, innovative thinking is required in this area, so that we not only move in a tractable path, but at the same time, we first of all deal with the most, should I say, serious, imposing factors that are inhibiting us even from thinking beyond the path that we want to take.
And Dr. Mariam, for the UAE, has a huge carbon footprint. It's about greening the whole economy, not just growing the green economy.
Yes.
Put that in perspective for us.
Okay. Well, let me start by thanking the QEF and Bloomberg for this opportunity. The subject of sustainability is very relevant now. And the UAE is conscious of its carbon footprint, which is clearly reflected by its giant efforts at sustainability. So the UAE's, there are a lot of plans in the UAE. Now we are looking into having a mix of energy. That we have the UAE Energy Strategy 2050. So we are now exploring a different mix of energy to, of course, fuel the economy of its needs, along with also looking into environmental also goals. So we have now renewable, we have nuclear, as well as clean sources, clean energy sources. So all of this, of course, we are taking into account that we need to have those powers in order to serve the economic requirement of the UAE as well as environmental sustainability. So to give you an example, we have now, we are also exploring different, like peaceful, the UAE Peaceful Energy, the Peaceful Energy Program, nuclear program. It's very successful. We have, it plays a major role in decarbonizing. We have also Al-Baraka nuclear energy plant, which is expected to save up to 22 million tons of carbon emissions each year. And also we have in the UAE the biggest three solar plant in the world, and the lowest cost. They are the largest and the lowest cost. So the Mohammed bin Rashid Al Maktoum Solar Park, it's the single point solar park in the world, and it's the largest single point, and it is expected to reduce over 6.5 million tons of carbon credit, carbon emission when completed. So, and what better proof of our commitment than hosting the global community of, to fight climate change, which is as the host of COP28. So the COP28 declaration called the UAE, consensus is like it was the historic agreement to transition away from fossil fuels. So all of this, that shows how seriously we taking the matter.
And Jim, we talk about the climate revolution, right? You have 30 years under your belt. I think 3 years in climate specifically. How does this climate revolution differ to other investment ways that you've seen in your career?
It's fascinating to sit on this panel. I was wondering what I'm doing here. I guess that I'm the practitioners. We have policy, we have development finance, we have markets, but my goal is actually to get the money going. And for those of you I don't know, I run the world's largest private equity fund focused on climate. And what I can bring is a bit of an on-the-ground perspective. So I think we have a lot to learn from the technology revolution. And it actually starts with perception. I don't know how many of you go to tech conferences. They're the same as climate conferences. Same bad coffee, same bad buffet. But the sound is very different. In a tech conference, everything is going to happen tomorrow. We're going to have self-driving cars in 2 years. AI is taking over the world the day after tomorrow. And everything is possible. When you go to a climate conference, we're never going to fix the grid in 50 years, and pestilence and death is there for all of us. Now, all of those things may be right, but we've spent so long focused on the need side of the coin that I'm not sure we've flipped it over to see the opportunity side of the coin. And the $7 trillion a year that has to be spent will not come if there's not $7 trillion probably of profit attached to it. And so one of the things we can learn from technology is that we have to define not only the need, but the opportunity. Policy moves on need, business moves on opportunity. Yes. And I think we've been so focused for so long and so rightly on the need here that we may actually be missing the opportunity. The other thing we've learned in climate is that it takes focus. You cannot be a tourist in the climate area. In the tech area, the people who were in the middle of it, who had a deep understanding of what was happening, were the people who actually saw the way and built the progress. One of the issues that I think we all have in the climate world is it's dispersed. There hasn't yet formed up a leadership outside of policy on how this is going to happen. And I think what we can learn about platforms, about business models, and how they can be applied to change can be transitioned from technology to climate.
You talk about opportunity and meeting the needs. It's also about returns to incentivize investors. And AFC, I know, have done pretty well in terms of getting those returns. Talk to us what you've done differently to get there.
Thank you for that. So again, like Jim mentioned, we've tried to look at the opportunity. And for us, the opportunity is developing to de-risk, so that you can make a case that is investable. And once you prove an investable case, working with partners to deploy that capital, innovating as you go to move from spending 5 years to get to financial close after you put in the equity, to finding ways to do construction finance, equity bridge, so that you can move away from thinking about whether the project will happen to actually looking at the cash flows from the project. So what we've done in the most recent project we commissioned, as soon as we got the PPA agreed with the government, we got a political risk guarantee in place. We just went to tender and we got the technology provider, proven track record, and we provided a construction finance instrument so that to build out the plant. So by the time we were talking to lenders, they could see the wind farm, they could see the masts, they could actually see the grid connection being in place, they could see transition lines, so they knew that we just have to look at the potential cash flows that will come through. And then we do that because Africa is perceived to be so risky, but the reality is not so. So what we are trying to do always is to move people closer to the reality as opposed to the perception of risk in Africa. And our returns, like you mentioned, demonstrate that we're actually more profitable than most listed infrastructure funds. So if you look at our returns over the last 12 years, they've been stellar. And what we do is constantly develop to de-risk and distribute to partners, reduce the percent of risk, show actual results. Like I mentioned, we just are commissioning our wind, solar, and storage farm in Morocco that provide 8% of the energy requirements of the United Kingdom. Again, that is to demonstrate that Africa has potential to work for itself and the rest of the world.
Right.
I want to punctuate this. All of us understand the opportunity, the need, but I want you to think about cell phones when you think about energy in Africa. There was a moment in 2000 where Africa basically leapfrogged. It just went right around landlines and built into a new technology, and some of the most interesting financial inclusion tools in the world came out of that. So we have to transition energy in Africa, but actually energy addition allows us to leapfrog if we focus on the opportunity, not just the need.
And also for Kenya, I mean, your power generation is green. I mean, how are you leveraging that, and and what kind of financing needs do you have to help you advance that even more?
That is how I was going to ring fence his point about policies need and also opportunities coming from private sector, because essentially we do imagine that the cost of transition is massive and we cannot make it. But the private sector is there. The private sector is there. It doesn't have constraints like individual governments. It doesn't have constraints in terms of finance, but it also doesn't have constraints in terms of technology. And the third one is that it is very sensitive to time to build. So in a sense, they can actually make sure that it moves with speed. We have a major cost in terms of upcoming transition cost. But we also have a massive cost in terms of debt. So you can imagine those two are inhibiting and pushing us to a low equilibrium trap. And that is why taking advantage of the private sector in terms of its own capacity and resources and also technology available becomes very, very important, so that we take advantage of that to actually bring the private sector to act. Then it means that we have to provide the policy space for them to act. So in actual fact, the solution is the policy space.
And for the UAE, capital is actually growing. I mean, when it comes to green bonds, sukuk issuances, you saw a record, and that's because of some of the measures that you've implemented.
Yes. Well, I represent the Securities and Commodities Authority, Capital Markets Regulatory Authority. And so since I spent like a substantial part of my life in, in this career, I have seen it. The regulators have, has to play important role in influencing the dialogue and efforts to contain, climate change, as well as to drive sustainability. So in the UAE Net Zero 2050 strategic plan or initiative, which aligns with the Paris Agreement, as well as the UAE Green Strategy 2030 target. It aims toward having sustainable efforts in this regard. So, of course, I mean, it's a long journey, and if you have such a long journey, you have like a strategic objective, you need to break it into smaller goalposts. One of the first goalposts is to have a common understanding of objectives. That is to have a common taxonomy. And then all relevant regulators should come together to one platform and join hands. We have done this, and we have started that in the UAE. All the regulators, ministries, authorities have formed the Sustainable Finance Working Group, which is, I mean, it contains all, the regulator in the UAE, and we have agreed on 3 public statements. One is like enhancing sustainability-focused corporate governance, bolstering disclosure, sustainability-related disclosure and sustainability reporting, and also having a taxonomy specific to the UAE.
Right.
Yeah. So I mean, as well as you said, in regard to the SCA, the Securities and Commodities Authority, we have issued. I mean, we have classified some bonds and sukuk as green. Just of course to encourage companies, and we had a big issuance, and also to reward them, we exempted regulatory fees from this issuance, as well as mandating sustainability report for investors in the annual reporting.
We talked about how we need radical solutions, innovation. Jim, is there any climate innovation that you're excited about, that you've seen out there? Pockets of innovation, perhaps?
So many. We're cracking natural gas and making hydrogen and clean carbon black for tires. We have EV toll companies that are electrifying air travel. We have new SAF technologies that are going to allow us to actually suck carbon out of the air and make it into jet fuel. What I'd like to leave with this group is on the front lines, we've met with 1,200 companies. There are solutions there. There is a sorting function that needs to go on. There is a lack of human capital who understand the peripheral vision of what's happening in this market. But beyond the need, what I'm seeing on the ground is extraordinary opportunity. And that transition of how we talk about this, there's a passing of the baton. It started with the scientists, it moved to the policymakers, it moved to those of you who are getting these markets open. Now it needs to move to the people in this room to run the last leg. And what I'm finding is the last legs tend to be pretty fast when you run it, and it's happening much faster on the ground than it is in the discussion. And if we can get some of that speed understood, we'll remind ourselves that capital is going to be the feedstock of this revolution, and all of us need to get the capital moving, and the capital will move to opportunity.
Where would you like capital to go to in Kenya?
I would like capital to go, for example, into renewable energy, because that is actually which can make the whole difference, which can connect us to the land, maybe smart agriculture, industrialization, and support the value chains that we have.
And that's the cheapest energy in the world today.
That is the cheapest energy in the world, but even investing in that cheap energy, I talked about transmission channels. But at the end of the day, I need to support his point that at the end of the day, for us to create that momentum, we need to change the institutional DNA. Institutions must be there to protect, develop markets and protect markets. The institutional DNA, I have two qualities for them. The first one is actually to uphold the legal framework. And the second DNA that I define as DNA is actually define the appropriate incentive structure. That is the reward structure. A combination of the legal framework and the appropriate incentives is going to encourage prudent behavior in the marketplace. And that is what is going to give us the drive. Thank you.
Just quickly, we're running out of time. I just wanted to talk about carbon credit. You talked about how it's failing us, Sumaila, but you say Africa needs to be the center of it. Very briefly, why and how?
So I think we need to focus on what carbon credit support is about: preserving forests, preserving peatlands, and preserving all the systems that can absorb carbon dioxide, the natural system that can absorb carbon dioxide. So the focus should be on preserving them. And our view is that the current practice of trying to just, I would say, feel good about pollution is not the way. I think we should focus on how can we provide alternative livelihoods, for people that are cutting down the trees. We need to keep the trees in the ground. We need to provide them alternative livelihoods. We need to have a clear focus on the 900 million people that don't have access to clean cooking and provide them alternatives. So it's by having the capital to develop good projects that can conserve the forest, that can conserve the peatlands, and that can absorb carbon dioxide from the atmosphere. That is the way to advance carbon credits.
Sumaila, Secretary Dungu, Jim, Dr. Mariam, thank you so much for your time. I think we needed at least an hour for this conversation. Ladies and gentlemen, thank you.
Thank you.
Please welcome to the stage Katie Koch, President and CEO of the TCW Group, Manfredi Lefebvre, Chairman of Heritage Group, and Yi Mei Li, CEO of China Asset Management Co., for a conversation with Bloomberg's Malika Kapoor.
Ime, Katie, Manfredi, welcome. It's great to have you with us. I'm going to get started in a second, but I just want to tell everyone in the audience that we do want to make this session interactive. So do send in your questions, and very shortly we're going to be polling you. So do be ready with your phones. You'll see a QR code. You can scan it and get ready to answer our poll question. Now, we are living in challenging times. We spent the morning talking about the geopolitical tensions we're seeing in the world right now. We have a difficult economy, and we have new problems thrown at us by AI every other day. But I'm an optimist, and I believe we still have an opportunity to accumulate wealth, and we're hoping that over the next half hour or so, you might tell us where those opportunities lie. So, Ime, I want to begin with you. Given that we do have a difficult market environment, we've seen the launch of new funds slow down. So tell me, China AMC's strategy, what is your strategy to deal with such a difficult market?
Well, thank you very much, and it's such a great honor to be here today. Well, it just has been the hardest 3 years, actually, in China's mutual fund industry with such a bearish market environment. But for us, because China AMC, our goal is to actually, well, to like Legos, we lay out the cubes that will best position ourselves and our strategies in any kind of environment. So in this kind of scenario, we really try our best to actually use our own money as seed money. So our IPOs didn't really slow down. In the past several years, in the past 3 years, we launched more than 150 new funds, new strategies in different areas that we think will best serve the interest and coming trends in the future.
Manfredi, you have said before that you describe yourself as a contrarian investor and somebody who likes to look at neglected areas. So as of May 2024, what area looks rather neglected to you?
There's so many. I mean, every area which is not sexy is neglected, no?
So what's not sexy at the moment?
Today, for example, in the spirits, we were saying, it's consumers, I don't know why, it's one of the first times with a crisis, consumption of spirits is not growing. Mm-hmm. But so it's a great moment to buy businesses and then improve them and grow them. So that's one of the areas. Service companies in certain areas which are, for example, related to shipping. Shipping is a business which is booming, but there are services to shipping which are not in the radar screen of anybody. So if I have to look, I try to look. I wouldn't tell you what I'm looking at, but I mean, there are things which are in areas which are ports and things like this which are neglected. But they have steady flows of business, very good perspectives. Besides being contrarian, I'm opportunistic, and then I try to go where I can bring value added because of my relationships and my knowledge, and I can bring good management with me. Because without good people, whenever I did without knowing I had good people, it didn't go well.
Katie, I want to talk to you about the economic picture. Let's talk about the US Federal Reserve and interest rates. There is a feeling we might see some rate cutting by the end of this year. What does that mean? What would that mean for portfolios and for asset allocation?
Sure. I'm happy to speak to the macro. I'm gonna ask Manfredi one follow-up question to help frame what I was going to say, if I could.
Yes, yes.
So you've invested in many travel companies. We were talking about it, but can you give us a sense of what you're seeing in the consumer? You said spirits is weaker, which would be across the high to low end. And what do you see through travel?
Well, I see the high end. Because I focus there because that's what I understand. That is where I have the relationships with the trade and I have the management. it's extremely strong. I mean, it's an increase of consumers who can trade up.
Yeah.
Prices are very good. Margins are improving on what you deliver. So it's very, very good. You do have areas of competition, which is, for example, if you want to order a cruise ship now, it's very competitive because cruises is so expensive, so successful that ordering ships is becoming very expensive. And because it takes now 4 years to build a cruise ship that would take 3 years. So the capacity of production is always the same, but that number, so it's going to cost more because the costs are related are the same. So the inflation in general, except for labor, has been massive.
That's helpful. And I wanted to get your thoughts on the consumer because I'll make a quick comment on that in the macro. But big picture, when we look at the rest of the year, I don't have the proverbial crystal ball, so I can't tell you when and if exactly rates are going to be cut. But I want to give people a broader perspective of how we see the world. There's two ways this is going to work out from here. The first is that we get a soft landing, which is what the market's obviously pricing in at the moment. And that happens rarely, but could happen, and that would be amazing. And if we have that soft landing, it's our view that rates would still stay elevated.
Steady, okay.
And then on the other hand, and I'll come back to the implications of this, we get a recession. And the world does move in cycles, so eventually we'll have a recession. It's hard to tell exactly when that would happen, but we are seeing some signs of weakening in the labor market. In order to get an outright recession, I'm talking about the US right now, to state the obvious, we need a weaker consumer. That's why I was asking about the consumer, which makes up 70% of GDP. Make a quick comment on that and then come back to the implications. What we know in the US, which I'm going to focus on the US because it's the world's largest economy and the consumer is the largest consumer in the world, so very important for global growth trajectory. We know that the low end of the consumer is under a lot of pressure, and that's come through clearly the last couple of quarters. There's a cost of living crisis. Any consumer company that caters to low-end consumer has reported on that. What we've seen more recently is the middle-class consumer starting to come under some pressure. So if you look at, for example, Starbucks is a great bellwether for the middle-class consumer. They've seen traffic slow down pretty materially. There's just one anecdote, but it's a good way to think about it. Their core customer, their hardcore customer that goes every day, like me, has hung in there, that needs their caffeine and is willing to pay for it. But then the one that goes in there as a treat, which is still the middle-class consumer, has fallen off pretty dramatically. So I would say we're in the early stages of seeing some downward pressure on the consumer. And then, of course, we would need job destruction. And I don't say that lightly. There's human misery that comes with that, but that's what you need for a recession. And we haven't seen that yet. But pulling that together in either of these scenarios, what we would say is that there is the potential of a credit event, because even in the soft landing scenario, if rates stay elevated, we still have a math problem for a lot of companies who had capital structures put in place the last couple of years that were highly levered, and they were put in place with the expectation that rates would stay zero. They haven't, they won't, and those are going to start to come under pressure. We've actually seen the largest number of corporate defaults year to date, not in private credit, which I can come back to, but just broadly corporate defaults that we've seen since the GFC. So there is some pressure there. And then if you get a recession scenario, that's pretty obvious how it creates a credit event. And I'll just end by saying, against that macro backdrop, what does that leave us to be doing? By background, TCW manages private credit, and public equities. In credit markets and public markets, we're overweight securitized assets, agency MBS, which is carrying over the index. And we're waiting for something to break, which we think, regardless of the economic scenario, as I just articulated, there's going to be some likely credit events down the road, and we want to be a liquidity provider when that happens. And I will say that the complacency of the market, to me, is incredible in two ways. First, we've had record IG issuance this year, so there's clearly appetite from, if I were an issuer, I would also issue at record credit tights. But there's been appetite to pick that, not from us, but from others, to pick that up. And I'm just going to end by saying, on the complacency point, there are some difficulties ahead. You alluded to them in your opening comments, and yet we are at equity valuations that are top decile, and we're at credit spreads that haven't been this tight in 20 years. So to us, the credit spreads and the level that they're at now are inconsistent with the macro backdrop, whether we get a recession or not.
Well, I want to see what the audience is thinking. So we have a poll, and I want you all to weigh in on the poll as well. So let's see if we can get the poll question up. Let's see. But I'm going to ask you anyways, and there we go. So which asset class do you believe provides the most compelling opportunities in the next 12 months? So if you have your phones out, please do send in your response. And while we're waiting for the audience to weigh in, let me ask you, which one would you pick? If you can just tell me 1, 2, 3, 4, or 5, which one? Email, start with you.
Well, I think definitely both 4 and 5 seems very interesting right now.
Commodities and crypto for you.
Commodity and the cryptos, especially cryptos.
Okay, Manfredi?
Equities. I'm always investing in equities.
Well, equities?
Yes.
Yeah, you're going to stick with equities? Okay.
I'm a simple guy.
Yeah. Okay. Katie?
I think from here, my idea would be in the second category, but more specifically, again, regardless of the macro environment, we see tremendous opportunities for rescue finance.
Okay.
That these higher rates are going to work their way through the system and create one of the first distress cycles in private credit and great opportunities for rescue finance.
Okay, so it looks like most people are with equities.
Wow, that surprises me.
That's interesting, isn't it? So since the room is voting in favor of equities, Manfredi, you talked about, you picked equities, you win.
What's the prize?
What's the prize?
You know, in the long run, it's no comparison what you get. If you have staying power, you can finance any kind of revenue drop on companies. If the product is good, there's no comparison on return.
But you have a very interesting way of picking equities. You do it directly, don't you?
Yes. I only, on the stock exchange, one stock. Which
one?
I know very well, Royal Caribbean.
Yes. Yes, of course.
I'm very confident. I know that it's incredible, very well-managed company, fantastic sector.
So how do you pick the equities that you're going to put your money in?
It's very opportunistic.
Okay.
It's very opportunistic. Then I try to give myself rules. So when I divested my Silver Sea company, I tried to give myself a rule. It said, okay, I immediately bought a company, Abercrombie & Kent. And then I said, okay, I'll keep, that's going to be 1/3. Then I'll keep about 40% cash. Listed shares. I don't want to have problems in my life. Then I'll invest some of it. The problem is I invested too well my money when I bought my business. So now it's overwhelming the part which is the business, Abercrombie & Kent and Crystal. So I have to find a way to fix it, to rebalance in other ways. So then we get a lot of opportunities. So Ukraine war starts. A friend of mine had 50% of a company with a partner. The partner had to sell because he was submerged by debt. I was the only buyer. So I gave him a price out of mercy. It was a great company, and it's growing, and it's, of course, it was in the spirits. It's a great opportunity. They brought us another business where you talk about 100,000, these kind of things. So they brought me a startup, which is not really a startup, already developed ice cream production. A very good Italian ice cream. Italian ice creams are the best, we all know.
Yeah.
And so then I committed some of the money. Then it's small money, so I don't want to lose too much time on small things. Then I went to the people working with me and I said, I syndicated, I gave them 100,000 tickets to these people. They're going to make 5 times their money. They could not do it by themselves, but following me, they could do it.
But Katie, this is an interesting time for someone who wants to put their money in equities, right? Because the number of IPOs we're seeing, it's going down. I mean, last year was low. It was the year before that, the number of deals was even lower. So talk to me about what a challenge this is for people wanting to put their money in equities.
Yeah, there's 2 separate issues. So at the meta level, the public markets are shrinking pretty dramatically.
Right.
And that is shrinking the opportunity set. I mean, you've only found one, right, that you like, Royal Caribbean. But it is...
I know it very well. I mean, it's...
And which is a good... you should invest in what you know, so I respect that.
Yeah.
But it has shrunk from 7,000 companies 20 years ago to half that. And that's happened for a variety of reasons, the perpetual availability of private capital through private equity. It's less fun to be a public equity CEO now. And that's a real trend that we should be aware of. I'll come back to. Last year, again, there was less IPOs than people thought. Part of it's that secular trend. Part of it was just that there wasn't visibility on rates, and so the IPO market closed.
Right.
We've seen some recovery this year. But I think the point you're making is a good one. We are in an environment where the public markets have shrank, and just, again, 50% less companies than there were 20 years ago. There should be multiples more than there were. And so investors have to be really selective when they think about what parts of the public markets they want to invest in. And obviously, ideally, they should be capturing part of that opportunity set through private markets as well, both equity and debt. One last comment. I think when you look at credit markets, what we're seeing, and the private credit's become obviously very topical, it's very mirror to what happened in my experience running equity markets for the last 20 years. We're just in the early stages of the credit markets being disrupted and more public capacity going private. And ultimately, obviously, what we're all trying to do is build portfolios for investors that cover both. And I'll just end by saying in equity markets, what we do at TCW is that we acknowledge that the developed markets, and in particular the S&P 500, is available highly efficiently with liquidity and tax efficiency and transparency for almost 0 basis points. So we don't compete in that part of the market. What we do is we offer very differentiated equity strategies that are either highly concentrated in developed markets, or we're focused on 3 themes of disruption that we build portfolios in that we think are positioned to win over the long term. And they're focused on AI, climate transition, and supply chain disruption are the main areas we're focused on thematically. And I believe that you can still find clients to partner with you if you do things that are active and differentiated and oriented for the long term. There's a lot of inefficiency out longer term, and people are underweight those themes in a market cap weighted portfolio. So they're good ones for clients to lean into.
I want to come back to AI, but before we do that, Ime, you had picked in the poll commodities and crypto. Now, China Asset Management, your company, launched a crypto ETF in Hong Kong just a few weeks ago. Is that right?
Yeah.
So what's the response been? And are you finding that people really are looking for more diversified portfolios?
Yeah, that was really a great experience because it was 2 weeks ago, actually, exact 2 weeks ago. So I guess that was one of the defining moments in Hong Kong's capital market, because it's the first time actually we can have a spot ETF and we can do in-kind creation for cryptocurrencies. And this is very surreal in the sense that finally there's a connection between the crypto world and then the traditional, financial markets. So from our point of view, and this is the first time actually people, especially for real, retail investors. So in the past, the traditional retail investors, if they want to invest in cryptocurrency, there's huge barriers, and they have no idea how to do it. And now we can see that so many distribution channels in the past, they don't really want to talk to us. And now they are just, start to actively engaging us how to offer this kind of products to their end investors, which is amazing how much I think the demand and interest are right now in Hong Kong. And also we've seen so many institutional investors, even though this is very early stage, they are trying to test the waters. They are trying to, just buy some and invest a little bit to see how that will affect the volatility and the asset allocation of their portfolio. So this is amazing, and we see great trend and opportunities in this area.
I think, sorry, go ahead, Manfredi.
No, ladies first.
I was just going to say, the congratulations on the launch of that. Obviously, in the US, we had some big ETF launches in crypto for people who are believers in that asset class. And I would say that those ETF launches are kind of like the IPO phase of the asset class. You said institutions are slowly looking at it. If you are a believer in crypto, this would cement the very early innings of how that asset class
are you a believer?
I think that there's a place for it in people's portfolios.
I guess it's not just real believers, but still, I think people are looking at so many ways to diversify their portfolio. And also, there was just this joke, because on the first day, one of the Bloomberg anchor actually tweet that if this could reach 1 billion USD in 3 months, he will come to Hong Kong and buy everyone sushi. So we will see if that sushi journey is going to come or not.
Manfredi, one thing I want to ask you is that, over the last couple of years, and it happens when we have political uncertainty in the world, that people shift their assets, right? There's a lot of cross-border movement with money. We saw, for example, a lot of money from Russia move towards the Middle East. Do you think the Middle East can become a global wealth hub the way Switzerland has?
It is already.
It is already?
Yeah. I have so many friends who have moved here or are moving here, either their funds or their family assets, and even to live here. And the movement which is going to be out of England, it's going to 66,000 non-doms.
The non-doms, yes.
Seeking for a new home for their money and for themselves. And with the trend of taxation in Europe and in the States, a lot of people are going to start moving. So it is. I mean, what you need is certainty of legal and fiscal environment.
And political
and we have this
stability.
here. Okay. Besides, to be competitive, you need to have less burden on your capital. Because otherwise, you produce capital and you pay taxes, and your competitor in Dubai doesn't. So you need to have reduced taxation. Otherwise, you have a limitation, accumulation of capital or profitability of the companies. So there's the asset here of stability and the certainty of the rule of law and for corporations and for tax is massive, I think. So I think that it is. And so many more and more people are moving here. I've chosen my life to be in Monaco. It's a small Emirates. We have a ruler who is the prince. There's very big stability. We've always had the same tax rules. They don't change. The governments have very limited authority. The government is the government of the prince. He decides his government, and he rules the country. And it's very stable. So you know what is going on. It's an incredible privilege that way. So I think that is... I wanted to add something.
Yeah.
These two ladies, they manage massive capital.
Yes.
Managing massive capital, they have access to very high talent. So I'm competing with them to allocate my money. So I do not have access to the same things they have. So I have always to make myself smart. Where can I beat them? There are a few things where I can beat them. I can beat them through my connectivity, my relationships, because I can go directly, and then my relationship employs immediately my money, which is limited, so I can find. And in the very fast decision-making process. So that's why I have to be very opportunistic, very contrarian, very going in areas which I know well. Because otherwise, if I go and I have to compete with them, I'm going to be a loser.
But I don't want to compete. I want to be friends so I can get a good deal. I have your business card here on the Abercrombie and Kent, my next Abercrombie and Kent tour. So
yes.
We'll be friends.
I'm always glad.
Okay.
They never want me to bring, because whenever I bring somebody to the company, I advocate for my friends.
Yeah.
Oh, don't charge them money. I'm not a very good salesman, but in any case.
I can't believe we're almost out of time, but I want to do something a little bit different and fun. We're going to have a rapid fire round. So I'm going to ask you to respond in literally like 3 or 4 words, no more, okay? Biggest challenge to wealth creation, Katie?
Current account deficit in the US driving inflation.
Okay, current account deficit. Manfredi, biggest challenge to wealth creation?
Stupid government legislation.
Okay, accepted.
Which is dominant.
Ime?
Adaptation to new technology.
Oh, I wish we had more time to talk about AI, but we might have to do that backstage. If you had $100,000 US to invest right now, where would you put your money?
I would do capital solutions rescue finance for companies struggling with the interest rate.
Manfredi?
Small ice cream company, which is going 5 times the money over money in 5 years.
Okay, that sounds good to me.
And delicious.
Already did it.
And half in crypto and half in AI equity.
All right.
Okay, there you go. This is the biggest election year in the history of the world. We have multiple elections going on, US elections coming up in a few months. Geopolitics, as we know, does affect wealth creation. The next president of the US will be?
No idea.
I'll give you a pass on that.
Me?
Yes.
What my wallet hopes.
What
That's
your
the most
wallet
important
hopes.
thing.
Yes. Who's going to be
He
better
hopes
for...
Trump, the wallet.
The wallet hopes Trump?
The heart will say, I'm not American, so it's nothing of my concern. For my money, I think Trump. But I don't think he's going to win.
Okay.
Because the deep state is, I mean, look at him. Everybody's campaigning, he has to be in a courtroom.
Ime?
Well, I wish it's either Michael Bloomberg or Michelle Obama.
We can send that message back. And my last question is, wealth to me, what does wealth mean to you? Wealth to me is?
Time with my family.
And Freddie?
Freedom of choice.
I love that.
Well, the ability to change a better world.
What a good note to end on. Thank you so much, Ime and Freddie, Katie. Thank you so much
Thank
for your
you.
time.
Thank you to everybody.
Thank you.
Every crisis in the West for the last 50 years has been ultimately resolved by the intervention of government.
Please welcome to the stage Kenneth C. Griffin, founder, CEO, and co-chief investment officer of Citadel, for a conversation with Bloomberg's Eric Schatzker.
Good afternoon, everyone. Ken Griffin, thank you so much for joining us here in Doha. Eric. Mic's not working? All right, we'll wait for them to... there we go. It seems to be working now. Yeah. We can sort these things out.
All right, let's start that all over again.
Let's start this all over again. Ken Griffin, thank you so much for joining us here in Doha.
Eric, it is great to be here today.
We have a lot to talk about, as usual, folks. I have been fortunate enough to have a long-standing relationship with Ken and have had the opportunity to interview him many times. I think of this as an evolution in so many ways, Ken, of things that we've touched on in the past. One of those things, of course, is geopolitics, a subject you've heard.
What a graceful way to describe aging.
An evolution. Geopolitics is a subject that has come up already many times on this stage, Ken. The world, as you know, is divided by conflicts. We have hot wars in Ukraine and Gaza, and a cold war, you might say, between the United States and China. And increasingly, these conflicts are forcing states to pick sides, and thus they're realigning global trade and investment. What we'd like here, Ken, is your perspective on the trajectory of these geopolitical trends and your ideas as to how they're shaping or perhaps reshaping the macroeconomic landscape you have to navigate at your firm, Citadel and Citadel Securities.
So that's a great question, because it was just a few years ago that I think most of us viewed the world as heading towards geopolitical stability.
A better place, in other words, yeah.
Yes, and a more integrated market, both financial, flows of goods, flows of services, and even the integration of labor markets. And now, with both the war in Europe, the tension between the United States and China, and then in a different way, what's unfolding in the Middle East between Israel and Hamas, it's very clear we live in a different world than we had all experienced and fantasized about just a few years ago. Now, the upshot of this is that the traditional alliances post-World War II are regaining strength. You see the NATO countries coming together more tightly. You see the United States trying to pull its allies closer together, whether it's Australia in the Pacific or our allies in Europe. So there is definitely a reassertion of the importance of global institutions, and in particular the post-World War II frameworks that are once again at play. As an investor, it's an interesting point in time, because if you are in the United States, there's a sense that deploying capital in the markets of our clear allies is the safest path to go. In fact, you'll often hear American money managers, for example, say that China is uninvestable because of the tension between the United States and China. That's on clear display. And yet, if you're here in the Middle East, where China is an important importer of oil and other products from across the region, it's a very different story. China is clearly investable because of the closeness forming between China and this part of the world. So you do see both the re-strengthening of historical relationships, new ties being built, and capital follows the flows of these geopolitical arrangements.
Are you worried about the direction the world is headed?
I mean, of course I am. And I'm willing to bet that you are also. This is not where we want to see the world head for just a number of obvious reasons. I mean, first of all, global trade, which had adverse consequences that we're learning about to this day, still unleashed an enormous amount of gain for humanity. And with the rise of global trade became the rise of information sharing around the world, which rapidly accelerated the trajectory of mankind. I mean, of note, the Chinese, for example, are leaders in solar. They're leaders in EVs. They're leaders in a number of emerging technologies. And a world which is more splintered will see the gains that the Chinese have achieved in these important areas not shared by the Western countries. And conversely, the United States is a clear leader in AI, along with a number of the European countries. And those gains will not be shared with China and the countries in its sphere of influence. So it's a very clear-cut loss for all of humanity when we have the severing of ties between our countries.
On a practical level, is it getting harder to manage the risks you face?
I think that one has to be aware that there are more tail risks that are harder to ultimately manage. And that goes with this rise in geopolitical complexity. So I think that's certainly true, that there are just larger tails today that didn't exist, or we didn't perceive them to exist 7 or 8 or 10 years ago. So that is intrinsic in money management today, and that's something that we think about each and every day at Citadel, is how do we mitigate the tail risks in this world?
How do you mitigate the tail risks?
Well, part of it's sizing. So part of it is how much exposure will you have to a strategy, or to a particular sector of the economy, or to a particular country. That is the go-to playbook for managing your tails, is just what's the most you're willing to have exposed to a possible adverse event. And then the other strategy is to look for correlated payoffs that will protect you in the event that the tail scenario occurs. So those are two things that you do in your portfolio construction to manage against the tail risk in this environment.
Ken, moments ago you mentioned China and EVs. As it happens today, the Biden administration is levying sweeping new tariffs on Chinese imports, including on electric vehicles. How does that change the picture?
Well, it's sort of a continuation of the incoherent economic policies of the Biden administration. We've seen this giant push towards green energy over the course of the last several years, and at the same time, a set of policies that run completely contrary to the stated goal of trying to head towards a zero-carbon world, and placing enormous tariffs on Chinese EVs, which are low-cost, high-quality, of great value to American consumers is yet another part of the incoherent Biden economic strategy. The other part of the strategy that I scratch my head about is the U.S. refusing to provide new LNG permits. Right? If you want the world to head towards a lower carbon footprint and move away from coal, access to LNG is a really important part of the equation. And yet the United States is refusing to permit new facilities in the foreseeable future.
And also to sell LNG to countries with which the United States doesn't have a free trade agreement.
That's a part of the equation also.
That said, the United States, amazingly, is a bigger LNG exporter than Qatar.
We're neck and neck. We're neck and neck. And it's very important to understand that if you want a country to base its economy on natural gas, they're going to want two suppliers. It's not a win-lose dynamic between the United States and Qatar. It's a win-win. If you look at any good that is required on an existential basis, you're going to want dual source supply, and the rise of the United States as a major LNG exporter only strengthens the position of this region of the world in providing natural gas to other countries.
Going back to China for a moment, we've talked about China in the past. You have what I would call a constructive view of China, certainly more constructive than many people with whom I've spoken. There is, however, strong hostility to China among both Republicans and Democrats. So how would you explain the way you look at the opportunity and the problem that China presents, particularly to the United States?
So that's a treacherous question to have to answer. Let's take a huge step back. I think that my view towards China is rooted in respect. It is rooted in the respect of a country that has pulled more people out of poverty in the last 40 years than any country in the history of the world. It's a remarkable economic achievement that they have unleashed in China. And it was an economic achievement that the United States firmly supported. We believed in America that the rise of a free market economy would lead to the rise of a liberal democracy. It was an explicit calculation that happened in DC that didn't actually happen in reality. So it's important to recognize that this was the goal of the United States, was to see the economic rise of China, hoping it would push it towards a liberal democracy. It didn't happen. The economy rose, did not become a liberal democracy. Having said that, today China is a powerhouse in research and development in a broad number of fields that are very important to the future of all of us around the world. And so long as we're able to maintain a constructive relationship and we can share the best technologies that our two countries and all the countries around the world develop and build, there's an opportunity for gain. Right now, we have, in some sense, a very muddled relationship. And it's almost as if we're trying to maximize the opportunities for mutual pain. And that's a difficult place to be. It makes the Chinese wary of trusting the United States. It makes the United States wary of trusting China. And there's just a lot lost in that equation.
It would make sense if what the United States wants to do is make an enemy of China, but that's not clear.
Well, I don't want to make this a U.S. only is going after China. It's a two-way street. I mean, the Chinese, for example, supporting Russia's ability to wage war in the Ukraine doesn't play well in the United States of America. So there's room for both countries to take definitive acts to just turn the temperature down and, well, if it's a cold war, then it's to turn the temperature up. I'm not sure which way you go. But to improve the relationships and the dynamic between our two countries.
Ken, Qatar is playing an instrumental role in the peace talks, or the effort to create peace, as it were, between the Israelis and the Palestinians and to resolve the situation in Gaza and with respect to Hamas. You've been outspoken about the pro-Palestinian protests back in the United States. They've roiled university campuses. You've been particularly critical of your alma mater, Harvard. Here's my question to you. When people here in the Gulf region, and across the globe for that matter, see the chaos at Harvard or Columbia or USC or MIT, and police in combat gear moving to clear encampments. How do you think that shapes their view of America?
Not well. Not well. And what is lost is that what's happening on campus is not free speech, it's anarchy. You know, at Columbia, when they storm a building, they vandalize a building, they're destroying property, and then they ask for humanitarian aid, which is the greatest of all ironies. It's just the wrong, it is the wrong dynamic that we're seeing take place on American campuses. These are students, most of these students on campuses are trying to learn, they're trying to have an education, and the universities should be really trying to encourage a constructive debate between the students of different backgrounds, whether they're from the Middle East, whether they're of Jewish origin. It's really important that the generation that will be the generation that runs the world in 40 years tries to learn from this horrible moment in history. And we're not fostering that environment on campuses today. And it's really, it's a huge, huge disappointment that so much of what we see on campus, you've seen the video footage of the kids interviewed. Why are you here? What are you protesting about? Often they can't even answer basic questions about what's happening in the region and why it's taking place.
Can people here, and I suspect those watching us around the world, are eager for your insights into what might happen during and after the U.S. election. How might U.S. foreign policy and defense policy change if Donald Trump were to return to the White House?
So if President Trump returns to the White House, I think you'll see a global perception of a stronger America. Now, the Biden administration's foreign policies, the actual policies, are generally speaking thoughtful, does not exude credibility or strength in its actions around the world today. Our positioning does not match the thoughtfulness of our policies. That's a very difficult place to be in a world which has the geopolitical cross currents that we spoke about earlier. And it means that those who are willing to push to see how far you can push America are willing to push harder than we want to see happening. And I think that anybody who knows President Trump knows that is not somebody you just push to see what's going to happen. That's the wrong strategy with President Trump. And so I believe that President Trump will have very good people in foreign policy and in the Department of Defense, but I think he will exude a level of strength that will help to stabilize the world in this very, very trying times.
There has been flagging support for aid to Ukraine in the Republican Party. Would Donald Trump abandon Ukraine?
No, he will not.
You're certain of that?
Well, this goes back to my earlier statement. You could never be certain about President Trump, and that's part of the reason that he is more intimidating to our adversaries. You never know exactly what the response is going to be. But knowing a number of people that he's close to and having actually brought this topic up, I think that President Trump feels he can find an off-ramp towards peace by reaching across to Putin and to the Ukrainian leadership. I believe he knows it's important to American interests that we do not abandon the Ukrainian people at this very difficult moment, and that we keep Russia's territorial ambitions in check. And a strong pushback against Putin will be part of the equation, if need be, to secure the peace in Ukraine.
What do you think he'll do with economic policy?
That's difficult to know. So neither administration gives me comfort in terms of a willingness to reduce federal spending. But I have no doubt that a Trump administration would be far less oriented towards regulatory overreach and far more thoughtful about the role of the U.S. government in the day-to-day U.S. economy. You know, one of the reasons that American voters are so unhappy right now is inflation is out of control. And inflation is out of control because of the expansive government under the Biden administration, the rate of spending, and the degree of intervention in the economy. It's causing energy prices to be higher. It's causing the cost of manufacturing to be higher. It's impacting every part of the economy in a way that the American voters are frustrated about. President Biden doesn't understand you need to break the back of inflation to give people the sense of economic security.
We have talked in the past about America's tendency, shall we say, to spend more money than it generates in tax revenue. And you have warned, Ken, of some catastrophic consequences if deficit spending isn't brought under control. What is the catalyst for an American debt crisis going to be?
So I don't know what that moment will be when there's an auction that goes awry or when the markets become dislocated. Financial markets, generally speaking, work very well until they catastrophically come off the rails. You don't necessarily get a lot of warning that there's about to be a big event. The crash of '87 is a great case study. You know, that day I woke up, I was in my dorm room trading then, and the stories of the day were about a small skirmish in the Middle East of frankly no consequence, and the health of First Lady Nancy Reagan. And yet we ended that day with the stock market down 20-some% and a number of American financial institutions literally on life support or near death. Happened in one day. One day. There was no big story that morning that would make you think that that day might have been the end of the US capital markets as we knew them. There was no warning. And so I worry that the debt crisis may have a similar construct, that there'll simply be a day where a major auction fails, and then you see a panic start to brew in the Treasury market. And the question will be how fast will the Fed intervene? What panic will that induce? Because government intervention under duress often just creates more panic. And then do we see a flood of treasuries coming back into the market from holders around the world?
It's a frightening prospect.
It is.
Back to politics for a moment. You've been a prominent donor, I would say, to Republican candidates. I'd like to know, how are you going to spend your money? How are you already spending your money ahead of the election in November?
So I have been a significant supporter of Republicans that stand for personal freedom, national security, and economic soundness in the United States. That has been a big focus of mine in this primary election, or this primary cycle. I want to see people in the House and in the Senate that represent the best of American values and backgrounds that prepare one to serve in public service. In the last election cycle, I supported a number of people who were veterans and who are now serving our country in the House, and they do it with the pride that our country deserves, and they do it with the integrity that our country needs. So I've been very focused on finding candidates who I think represent the best of American values to be part of the future of the Republican Party.
People probably want to know, have you donated to Donald Trump's campaign, either directly or indirectly, to a PAC or a super PAC?
I have not.
Will you?
I'm going to wait to see who he picks as his VP candidate.
Is there anyone whom you'd like to see him pick as his VP candidate?
I don't. This is, again, like poking the bear. Not sure which way my recommendation goes in terms of helping that person's prospects.
I think that's a wise position to take. Before we finish, Ken, this region is blessed with resource wealth and, as a result, sovereign wealth. So much so that pretty much every major asset manager in the West sees the Gulf as something of a honeypot and is trying to raise money here. As someone who isn't raising money here, how would you advise the sovereign wealth funds in the Gulf region to maximize their negotiating leverage?
So either I'm going to be excommunicated from this circle of my fellow money managers, or never invited to come back to the Middle East again. Is that the position you're putting me in? So look, here's what I think is important to think about. I think alignment between the interests of the money manager and the sovereign wealth fund are very important. And I think it's more important to have your money entrusted with a firm that is going to act continuously in your best interest as an investor than it is to try to pick somebody who simply has the lowest fees or some other superficial demarcation of being open and transparent. I mean, let's be clear. Your money managers who have really important intellectual property aren't going to be unduly transparent. They're trying to protect their very intellectual property that they'll share the benefits with you with the client. Simply put, Coca-Cola doesn't publish its recipe on the web. So I think it's very important when you find a money manager, you're really asking, what's their competitive advantage? What's their culture? How aligned are they with me? And in the good moments and the bad moments, are they going to put themselves in the shoes of their clients and make the right decision by their clients? You know, at Citadel, I take great pride that almost over 20% of the capital in our hedge funds is the capital of the partners and the team members at Citadel. We wake up every single day as co-investors with our capital providers. And I think that symbolizes what I would think about looking for if I were a member of the sovereign wealth community here in the Middle East.
One last thing. Among the many distinctive qualities that Citadel is...
Just by the way, when you're going to go pick a brain surgeon, do you find the doctor with the lowest fee?
That's not what I would do, no.
Right, so you want to find somebody who actually has pricing power because other people perceive them to be good.
It says something, yes.
There's something to be said for that.
I was just going to say, because I think it would certainly interest people in this room and elsewhere in this part of the world, one of the things that Citadel is known for is how seriously you and your colleagues take the search for extraordinary talent. A number of investment firms have opened offices in this part of the world, whether it's in Doha, whether it's in Abu Dhabi, in Dubai, for example, or Riyadh. Have you thought about expanding here?
Well, we actually just recently did an analysis of our competitors' footprints in a number of these cities as we tried to think about what is our strategy here in the Middle East. And you landed on the right issue. It's about talent. And when we think about our Middle East strategy, we're going to think about where are we going to draw the greatest amount of talent, both from the domestic country and from the international community. Too often, countries try to attract talent by having very attractive tax attributes. That tends to draw in a handful of senior PMs, but doesn't draw in the analysts and the associates who do the day-to-day work that's required to be successful in the markets. You know, one of the reasons that I think Citadel has been so successful is the intense collaboration that we have within our four walls. A PM working side by side with an analyst, with an associate, working through a problem. Having a PM located in a low-tax jurisdiction on Zoom intermittently with a team back in London, that's not a winning formula. So when we think about where we're going to be in the Middle East in terms of our footprint for human capital, it's going to be about a holistic solution where we've got people who are in the region integrated tightly with PMs who are here. The whole team is here and successful as a team.
It explains a lot. Ken, thank you very much. Ladies and gentlemen, please join me in thanking Ken Griffin.
Thank you, Eric.
We've come to the end of today's sessions. Of course, I want to thank all the speakers for sharing their valuable insights and contributions throughout the day, and thank you all for being such an engaged audience. We'd also like to thank our official partners, the Ministry of Commerce and Industry of the State of Qatar and Media City Qatar, our innovation sponsor, Qatar Research Development and Innovation Council, our premise sponsors, Qatar Investment Authority and QNB. And thank you to all our other sponsors for making this forum possible.
And don't forget, tomorrow's sessions will begin at 10 a.m. in the morning with additional breakout briefings in the Fairmont Hotel, just like today. We now ask that you please exit the ballroom and move to the networking area. Thanks again for joining us. We'll see you tomorrow morning.